Hey, welcome everybody. My name is Michael Camo. I'm director of content for T3 Live, and I'm here with Sami Abusaad to talk about China and a whole lot more. Hold on just one second. I am hearing YouTube in my own ear, and I don't know why. Okay, all right, we're good now. Okay, all right, sorry about that, guys. Okay, so Sami, how are you doing today?
Doing great.
Uh,
Having an amazing day because I took 36 earnings trades and the vast majority of them worked. So doing really well.
okay, all right. So today we're going to talk about the first big thing is it time to bet on China? FXI is about 27% off the lows. Sami told me some very interesting things about his views on China. We had a little controversy last week. Things got very, very ugly between me and Sami discussing Tesla. We're also going to talk Apple earnings, whether Starbucks is the next Disney, these booming obesity drug stocks, and the MSOS roller coaster. So, Sami, big topic is China. So, China collapsed. It's come up quite a bit, but it does feel like it is off the radar for most people. So, what do you see in China?
I I'll tell you what I see. I see without a shred of doubt that it's bottomed. That's what I see. When people, most of the time, when people are not noticing something, like if you hear people talking about it in the news, buy China, you can be sure it's not the time to buy it. But when you hear deafening silence, and you see that the stock or the sector or whatever it is, the ETF is bullish, and that's when it's usually because usually the bottom creeps up on people without them noticing it. And I'm pretty sure China has bottomed. There's a lot of good China stocks that look amazing on the longer term charts, but if you didn't want to take the individual stocks, BZ, I mean, just right here is good. Is not late. A lot of them are late. Like I'm in the Baba. I mean, that's like way up, right? So a lot of them are really late now. But if you don't want to worry about selecting the right individual stocks, and I can give you a list, like I have 18 on my charts right now, but I have in a spreadsheet, I have about 50 items. You can just do the ETFs. And the two main ETFs for China, I know the FXI is the main ETF, but I like to do the leveraged FXI, which is the yen, personally. That's the one I'm in. I have 4,500 shares, I believe, either 4 or 4,500. No, 4,000. And I have the CWeb, but I only have 1,500 because I got it late. So this is the leveraged internet China stocks, and the yen is the leveraged FXI stocks, which encompasses everything. It's
Uh,
like our S&P 500 in ETF, right? So those are the ones that I like to trade the most. I'm not trading them. I'm investing in them. So hopefully, caught the bottom, and then you can look for the next pullback. As you can see, they pull back quite a bit. I mean, up, down, up, down, up, down, up. Probably the next pullback will be deep. So that's what I would do. There are some individual stocks that are not, I don't think, are too late. One of them would be BZ, like I just said. The TAL, though, it's going. There's a buy set up on it. The got you popped a good amount, but that's not late either. Baba's a little late. The Billy is late. The JD, which I was in but didn't get back in it, is too late. HSI is not late at all, but it's not my favorite. TME is a little late. In it for months now, the TME, and the YMM is a little late. So there are a few that are not late, like the TL, the got you, the BZ, and then you can wait for the next pullback on those stocks, but as well as the ETFs.
okay, but when we started, you talked about the concept of deafening silence. Now, we can't measure silence. So, is it just China was lost in the general conversation about the market?
Uh, I think so. I think people got really bearish on China, and rightly so. And then they never, they forgot to go back and take a look. Maybe things improved, maybe things changed, and they have. I don't know what the what the facts on the ground are. I don't follow the news. I don't, especially not China related news, but I can tell based on the chart that that should be the bottom. And if you look at the larger time frame, that's the daily chart. But if you look at also the larger time frame, look at that transition. Look how it ended the long-term downtrend. It's been in a downtrend since I think January of last year. I mean, it's been in a downtrend since the end of 2021. Excuse me, that's 2 years, and finally ended the downtrend. So you don't have to, So for me, when I see that a long-term trend is breaking and nobody's saying anything, that's actually a very healthy sign. If everybody's saying buy, 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 it means, okay, they buy it, and then who's left to buy it? There's nobody left to buy. But now when people start to talk about it, to notice it, and you're already in it, guess what? It's only gonna add fuel to the fire. It's only gonna add more demand to the ETF or the sector. But if everybody gets bullish on it all at the same time, it's not a good sign, because the rally will normally be short-lived. Look at BABA weekly. I mean, you can't ignore that. Look how it's breaking the downtrend. See it? Long-term downtrend. But these are not even the best setups. But look at the downtrend from $380, I think, to $80, and now it's breaking out. Let's take a look at the JD. Same thing. Let's take a look at Billy. Same thing. Let's take a look at the YMM. Same thing. Even better, but a little bit late. Let's take a look at Billy. The same thing. Let's take a look at TME. Is a little late, but here's what I'm looking to see happen on all these stocks that are just breaking the trend, like the TME did several months ago. You see how beautiful it is? This has been called in the newsletter since January, I believe. We've been in it in the newsletter. You see what I mean? So look at the TME. So the TME, it's the same as the other ones, but it happened several months ago, breaking that downtrend after a really big drop. The other ones that I just mentioned, other than the TME, they're just for the first time breaking their long-term downtrends. BEKE is another one. And I can look at my charts. These are just off the top of my mind. I can look at my charts and find some more, but I just gave you like a dozen names that are just breaking the long-term downtrend. And if you don't know how to picture to forecast the move, believe me, that's hard. Just look at the TME, how it did it, right? Was the same thing in a long-term downtrend, broke the long-term downtrend, and I don't know how much it's up. It's like up over 100%, basically, after breaking that long-term downtrend. I'm not saying there are no guarantees. I'm not saying this is a sure thing, but I am acting on it. I'm acting like it's a sure thing. I probably have a dozen symbols or so, in addition to the yen and the CWEB, which are the main ETFs.
Okay, Sami, how about Baidu? I think that might have been the only one that you haven't mentioned, but some people are starting to talk about it because they're throwing the AI label on it.
Right, after their agreement with Tesla. Baidu is is maybe the worst of them. But you see how it's under the moving average that's the monthly. All the other ones that I mentioned are transitioning higher, meaning above the 20 on the monthly, and the 20 is starting to curl and point up, right? But Baidu is a Chinese stock, a major Chinese company, so it's gonna go with the rest of the market usually. Whether it's a dog or not, which it is, it will probably follow the rest of the market. But do I like it? I don't. And if I don't like the technical picture, even if it's in the right sector, I never have the confidence to hold when it goes against me hard. That's the thing, is you want to take plays that you feel you will be able to stick with when they go against you, because you have confidence in the setup, in the play. And so Baidu, I didn't mention it because it doesn't look that good. But again, it's a major Chinese stock, so it will probably follow the rest of the China market.
Okay, all right. So we need to talk about me and Sami need to clear the air, because Sami and I have been friends for a long time, but there's been a distance between us over the last week, and things are getting a little nasty. So we need to clear this up a little bit. I'm just kidding. I'm just kidding. I love Sami. So okay, so we got into a little debate last week over hedging. So Sami had this gigantic Tesla position heading into earnings. which was definitely a good thing because Tesla went up huge after earnings. So that's why Sami was in such a good mood the next day. Now, now Sami had hedged this large position with a short Tesla ETF. Sami, is the story accurate so far?
So story is accurate, except that you people think now we have a rift between us, which we don't.
I know. I'm just kidding. I just like a little controversy. Okay, so my argument was that hedging almost never. If you're hedging, your position is too big or too small. There's another reverse psychology issue we could talk about another time, where I think when you're in something big and you feel the need to hedge, you should actually buy more. But that's a whole nother issue. Okay, so back to this Tesla issue, Sami. Why did you not like sell the stock and buy it back the next day, or rather than complicate things with a hedge?
You're making it way too easy for me, Mike, here to win the argument, because I may not be able to buy it to get back in it. If I got out of my, you're right. When you're hedging, it means you have too big of a position. 100% correct. And I did. But if you are suspecting that it might be a long-term position, you want to have as big of a position as possible. If you're suspecting that this might set the bottom for months or years to come, you want to have as big of a position as possible. But how do you do it without taking on, too great of a risk? You do it by hedging, right? Now, the question is, why hedge when you can just buy more shares if the play works out? Because when do I add to my position? When can I buy more shares? Only if I get a new setup. But what if the stock just pops and keeps going and doesn't give me a setup, doesn't give me a way in it? You see what I mean? So then I wouldn't be able to add. And this is precisely what happened with Tesla. So it gapped up this day, the next day popped again, doji bar, and then gapped. I don't see a pattern on the Tesla, meaning if I did not oversize my position at the bottom, I would not have added to it. I would not have been able to add to it, or added significantly enough. Maybe I would have been able to add a little bit, but added enough to make a difference. So that's the key thing, is if I knew that if the play worked out, I can always add to it, I would never oversize anything. I would always take just the appropriate size given my risk tolerance, whatever, given my account size. So I would never oversize anything. But the problem is sometimes you get in it and you say, well, I'll add on the next entry, and it never comes. And it just keeps going. Like I told you a few minutes ago on the yen, right? I said it's probably too late now. Wait for the next pullback. What if the yen just went straight up to $60? What if it did, and you never got the chance to pull? It never pulled back. Never gave you a way to get in it, or if you were in it small, to add to it. That's the main reason why I hedge, because I when I oversize things, because I do want to approach it in a professional way, and not oversize my position, go crazy with it. But sometimes I do want to go crazy with it as long as I hedge it. So I hope that makes sense, Mike.
Okay, it makes sense. Okay, so I think in the logical question is, how much are you giving away to put on the hedge? Because my concern with hedging is that if you hedge, let's just say it 20 times in a year, I'm 100% positive you're down money. Those hedges will cost you way more than you potentially save. So how much are you giving away to put on the hedge?
So the way the formula works is that you're supposed to hedge whatever amount you're oversized by. So if you're oversized by $10,000, that's the amount that you're supposed to hedge. So that's how the formula works. And Mike is 100% correct. The hedges cost me money the vast majority of the time. But without hedging, I'm not going to be able to oversize my positions sometimes when I feel I really need to go all in on a stock. And you might say, well, why don't you just go all in? Because as as a professional trader, as somebody who approaches trading in a professional way, I can't just, put on random risk size. I can't just like say, well, I really like this play. Let me risk $10,000 on it, or 20 or whatever. And then on everything else, $500 or $1,000. I can't do that. I have to have consistent risk on each trade, risk amount on each trade. But sometimes I can, I've been trading for 17 years full time, right? So sometimes I can tell this might be a long-term bottom. I better get in. I better get as big of a position as I can take, but to do it in a professional way and to feel comfortable and to be able to hold it if it went against me, I have to hedge a little bit. But you're absolutely right. The vast majority of the time, the hedges cost me money. 100% correct, which is as it should be, because it means my trade was correct to begin with. I want the hedges to cost me money. But you're right, Mike. I'm in agreement with you.
Yeah, I think we're talking about the same numbers, just arranged differently. Okay, so a related question: why not just buy put options?
You could. That's a form of hedging. I mean, it's the same. You could do it. You could hedge with options, or take the inverse ETF if there is such a thing, which for Tesla there is. I did the TSLQ, but you could do options. I just don't do options, but you could. That's probably the better way to do it, honestly.
Okay, so final question on this topic. Now, I'll make a confession that sometimes I use reverse psychology on myself, and some of my best trades I've thought something was going to collapse, and then I'm on the verge of buying puts, and then I realize, like, my own brain is so predictable, I will turn around and buy calls. And some of my best results have come from doing the exact opposite of what I initially thought to do. So as it relates to hedging, do you ever think, wait, maybe I should buy even more of this if I'm that freaked out about it? Maybe, I don't know how I know my instincts are completely backwards and make no sense.
No, your instincts are correct, because trading is very counterintuitive. What Mike is saying is 100% correct. Most of the time, when you feel very, very strongly about something, you should do the opposite. When you feel very, very strongly about something, you should do the opposite. Most of the time, it's like I don't know if you read Marty Schwartz's book. It was called Pitbull, and he said that when he was taught that when he's in a trade and it's going against him and he can't take it anymore and he feels like puking, he said that's when he doubles up. So that's when he, used to double up the position. Another counterintuitive thing is, if you're in a position and, let's say you've been in this position, been losing money for a long time, and it finally got to break even, what do people do? Like almost 100% of the people, the traders out there, when the trade finally gets to break even, what do? They sell it. You should actually add to it, probably. I'll give you an example real quick. My brother-in-law, I gave him Tesla at 113, my own brother and my brother-in-law. I gave him Tesla at 113 is where they got it, right? He was down on it like a considerable amount. So when it got to 170 exactly, he got out of it, because that was his break-even point. I told my sister to tell him, don't get out of Tesla, because I knew he was going to get out. He had been telling me he can't wait for it to get to break even. And it was at 170. From he got out, it shot up to 300. That was back here. 170, it got to 299. So what's the moral of the story? The moral of the story is, what typically feels is the logical or right thing to do is usually the wrong thing to do in trading. It's very counterintuitive. One last thing about this is, in the book, what is it called? Market Wizards by Jack Schwager. He says the market doesn't pay you to do what's comfortable. It pays you to do the uncomfortable thing, such as buying low and selling high. That's comfortable. That's why it usually doesn't work. Buying high and selling higher is usually the way it works, right? That's one thing. Another thing is, if you get out, if let's say that you're in the stock you bought it at 200, dropped to 100, and now it's back up to 200. It feels it gives you a great relief to get out of it at break even. So it gives you, that's comfortable. That's what everybody does. The market doesn't work like that. If it actually gets to 200, your break even point, you should probably add to it or not exit. But if you ever look for comfort in trading, if you ever do what's comfortable, you can be sure it's the wrong thing to do in trading. It's just the way it is, unfortunately. I wish trading worked the other way around, meaning doing what's easy, what's comfortable is what made money, but that's not the case at all.
Okay. All right. So Sami, I think this is actually a good time to pivot to talk about Starbucks, because this is the stock that right now nobody wants to own. Jim Cramer emotionally abused the CEO on CNBC. You guys should look it up. It's actually a very entertaining clip. It's like Starbucks is now, it's 2022 lows. And now you had a big win with Disney this year, which came back. And it feels like Starbucks is a very similar situation. It's a big brand. Everybody knows it's quote unquote cheap. And everybody, by the way, I own Starbucks and I'm down big on it. So, but yeah, Sami always tells the truth. So we're good.
I always tell the truth because the charts are the truth. Like if I'm reading the charts, I'm going to be telling you the truth. And so in terms of Starbucks, a lot of times the way stocks bottom, I mean, the vast majority of the time, the way they bottom, they don't just go drop, and then they bottom. No, they gap and then they bottom. Look at Meta a couple of years ago, how it bottomed. Look at Tesla, it also gap. Go back to any stock you want that is way up now and see how it bottomed. You will learn a great deal. And a lot of times they bottom after a gap. The gap needs to have a spike in volume, which I see that the Starbucks did. But I'm not sure that it's bottomed just yet because it hasn't taken out I don't think it's taken out the prior monthly support yet. Usually it shakes everybody out and then it bottoms. The way one can do it is if you think it's worth a shot, or you think no, this might be the bottom, is to wait for this bar to close and play long above it. So long over that bar's high, stop under yesterday's low, whatever it is. So you can try it that way, but I'm not sure that Starbucks has bottomed just yet. The other big thing about Starbucks is that it's a market stock. It's a big name that's going to move with the market. And if you were to ask me about the market, whether I think it's higher or lower, I wouldn't know what to say, because right now I think it's a do or die situation. I know what to say. Don't get too bullish if you want to get bullish on China, that's not US related, no problem. But don't get too bullish unless we take out this pivot here on the daily chart of the Qs or the SPY. Whatever the high of that pivot is, we need to close above it. So on the SPY, it looks like it's 510.07. So we need to close above it before you get comfortable that the market is higher. But for now, in fact, short term, we're looking lower. We're looking lower, not higher. So Starbucks, being that it's a market stock, it's not a separate stock. It's not like oil. It's not gold. It's not China. It's not whatever. It's not something on its own. It probably will follow the market. Not sure it's the right time to do it. But I told you what the entry would be if you think this is worth a shot, which is over today's high. Stop under yesterday's low. So that's my reading on Starbucks for you, Mike.
Okay, all right. So we are going to close out in a little bit because Sami has to get going. But Sami, you know who is coming. Apple is coming tonight. And yeah, it seems like people are bracing for a lot of confusion. So what are you seeing the setup with Apple now?
Okay, so Apple is not easy. There's plenty of easier things to do in terms of as earnings plays, like to buy it before earnings. But I do see something, which is, you see how the 20 was declining, and every time the stock tried to go above it, came back in, tried to go above it, came back in, tried to go above it, and came back in to where? To the newly rising 20. So I see that it's transitioning on the daily chart. It would be great if Apple held up and didn't come crashing, didn't close weak today. If it does hold up, I think it would be worth a shot long on Apple. If we also look at the monthly, I mean, that's as pretty of a buy setup pattern on the monthly as it gets. Honestly, love it. Again, there's probably a lot easier symbols out there. I'm gonna start the scanning right now in a little bit. But Apple, to me, if it can just stay up here and not close with it as a big red bar, if it can just stay up near the top, we can look at the smaller time frames. It's already coming in, but I just don't want to see it close weak. But I think Apple will gap up on earnings. I would not short it at all. It may not gap up, but I would. I'm gonna actually look. I'm gonna probably play it long as it doesn't close weak today. Okay, but yeah, looking good because of that transition on the daily chart. The weekly is super iffy, declining 20. It's already at resistance on the weekly. So again, there's better setups out there, I'm sure, but Apple is not a horrible setup long, I think, in my opinion.
Okay. All right, guys. So if you want to get Sami's ideas in real time, we recommend you join the Strategic Day Trader VTF, where that's Sami's day trading room, where he gives you all the ideas in real time with entries and exits. There's live coaching every Tuesday. You could start today for $49. LI, which is a China EV play, was one of the longs today, and Sami got in at 28.55, and it's still going up. If you guys saw, FXI just broke through 27 for the first time in like a decade. So yeah, so if you want to play these China stocks, especially in real time, join Sami. If you want to join, go to t3live.com/Sami Live. The link is also down in the description on YouTube, Facebook, and LinkedIn. If you're watching on Twitter, the link is in the tweet. And we will, if you're on T3 Live's email list, we will send the link to you to join. But guys, t3live.com/Sami Live. And I hope you'll join us next week, because it's going to be part 3 of this hedging drama. It's going to continue on next week because I've spotted some new holes in Sami's logic that we are going to tear apart. So, Sami, as always, it's a pleasure. Thank you for joining us, guys. I hope you come back next Thursday, 12:30 p.m. Eastern time.
I'm going to unleash this bull on you, Mike.
Okay, now that's the sign. The market is about to crash.
I'm going to unleash this bull on you if you keep with the hedging discussion.
So he's wearing the bull shirt right before Apple earnings. Sami, you have me very, very worried.
Well, we'll see. Yeah, it means it's going to crash. No, I really do like Apple, actually. All right, guys. Thanks so much. Thanks, Mike.
Thank you,
To be
Sami.
continued next week. Peace.